Okay, I'm going to begin. My name is Richard Joy. I'm the Executive Director of the Urban Land Institute, or ULI, Toronto, and I'm pleased and proud to launch our 16th annual ULI Toronto PwC Annual Trends in Real Estate program. As a Toronto region-based organization, we acknowledge that the land that we are meeting on virtually is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabeg, the Chippewa, the Haudenosaunee, the Wendat peoples, and is now home to many diverse nations, First Nations, Inuit, and Métis people. We also acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit, and we are grateful to have the opportunity to work on this land, and by doing so, give our respect to its first inhabitants. To better understand the meaning behind this land acknowledgement, I recommend a program that we hosted last June, 13,000 Years of Indigenous History in the GTA and Why It Matters to Planning and Development, the link for which we will post in our chat. I also recommend an upcoming ULI webinar this Tuesday, Whose Land and Whose Law, Indigenous Land Rights in the GGH, Greater Golden Horseshoe, examining the duty to consult and accommodate. That's next Tuesday, and again, that will be posted in the chat. ULI Toronto and PwC Trends in Real Estate is one of our most anticipated milestones of the year. Although this year's program looks much different than the last 15 years, you'll recall, many of you, last year we were meeting in the lovely Carlew Theatre. We are excited to be able to offer an expanded virtual version of this program. And we have over 600 people registered this morning, incredible. I hope that some of you were able to connect with your peers during the pre-event virtual networking that just took place. Before we get started, I'd like to do a few quick housekeeping items for the day. Everybody will be automatically on mute and your video has been disabled. If you are experiencing any technical issues, please direct them to the chat box. This program is being recorded and will be sent to participants following the session and will be made available to ULI's Knowledge Finder platform in the coming weeks. If you want to take the conversation online, please tag us with the handle @ULI Toronto and @PwC_Canada, or by using the hashtag ETRE2021. You should all have received a digital version of the report to your email already. If you didn't, don't worry. We'll be posting the link to the chat again for you to download. So here's the agenda for today. After our opening plenary presentation and panel session finishes at 10 o'clock, we'll take a 15-minute break. At 10:15, everybody will move into the concurrent session that you pre-registered for. You should have received the links to your email for your concurrent session this morning. If you did not receive that communication, we will post them to the chat later on in the program, so don't worry. After that, at 11 o'clock, we'll take another 15-minute break and then reconvene at 11:15, closing out the program with a great fireside chat conversation with John Love of Kingstep Capital and Elia Mohammed of TD Securities. So for now, I'm going to pass things over to ULI Toronto's Vice Chair of Mission Advancement, Cindy Rotenberg-Walker, Partner of Urban Strategies. Cindy, over to you.
Great, thank you, Richard. As Richard said, my name is Cindy Rotenberg-Walker. I'm a partner at Urban Strategies. I'm also ULI Toronto's Chair of Mission Advancement. On behalf of ULI Toronto's Toronto Management Committee, I'm really pleased to welcome you all here today. Before I introduce our keynote speaker, I would like to take a moment to thank our annual sponsors for their continued support of ULI Toronto's mission to advance the responsible use, of land. Nearly 8 months into the COVID-19 pandemic, our dependence on our annual sponsor companies has never been greater or more important. Our annual sponsors ensure that ULI Toronto can produce important and timely webinars, community outreach, educational programs from high school through to mid-career, women's leadership, equity, diversity, and inclusion, support for our COVID-19 frontlines, and so much more. Indeed, their increasing and ongoing support of our district council's activities is the very foundation of our growth and our impact in the Toronto region. Finally, I would like to thank PwC for their continued partnership in this report and today's event. In particular, I would like to acknowledge the lead PwC Canada senior advisors of the Canadian chapter, Frank Magliocco, Chris Potter, Fred Cassana, and Miriam Gurza. It is now my pleasure to introduce our keynote speaker, Andy Warren. Andy currently serves as PwC's Director of Real Estate Research, where he is responsible for monitoring all aspects of commercial and residential real estate, including space market fundamentals, capital market trends, regulatory changes, and operational development. For the past 8 years, Andy has researched and co-authored the emerging trends in real estate publications. He is a frequent speaker on issues affecting the real estate market and has also authored numerous articles for internal clients and national real estate publications. Andy, over to you.
Great, thank you, Cindy. It's interesting. They say that when public speaking that it's always nerve-wracking when you walk out on the stage and see everybody. But actually, I think maybe getting the technology down of doing it virtually may be a little more nerve-wracking than actually doing it in person. But it's great that we can actually do this. So thank you very much. And I take no offense at this country of Canada closing their border and not allowing me in this year, because I was looking at the numbers just to kind of see what the COVID cases were, and the state that I live in the United States had more cases yesterday than the entire country of Canada. So I think closing the borders might be a good idea. But you're absolutely right. This is a very unique year for emerging trends. And so with that, I'd like to get the program started. This is that technology thing that we always cross our fingers and hope it works, but looks like it is. So, emerging trends has been around for 42 years. As Richard mentioned, the 16th year for the Canadian edition. And this has probably been by far the most unique year. But fortunately, through technology and what we have available, we were able to actually put together a report. We did change the timing to try and get the most recent information. All the interviews were done online or virtually, I'm sure. Maybe a few face-to-face, but it's been a challenge, but it's been an exciting one. And there are a lot of things that I think we'll be thinking about for the next year. Get my slide to advance. Once again, there we go. Talking about, the pandemic, and I'm sure I mentioned it last year during our presentation that, we always have a black swan event. And we put this slide in January of this year when the coronavirus was being talked about. And these were the things that people were concerned about for 2020. It was the coronavirus, the election cycle in the US, geopolitics, and social unrest. Well, 3 out of those 4 have actually been issues that we've had this year. Obviously the coronavirus, I don't think anybody anticipated the impact it would have. The election cycle, partially because of the pandemic cycle, has been much more rancorous, to say the least, and maybe divisive. And then the social unrest from the unfortunate death of George Floyd early in the summer created that. When we were thinking social unrest at this time, we were thinking the protests in Hong Kong. But things kind of changed. I think it's interesting, though, pandemics have not always been, we've asked the question in the Emerging Trends Survey, but it's never really been of great importance. But last year there were 12%, that 9%, and that 3% on this graph kind of show people that said it would be of great or considerable importance. So 12% of the people actually thought it might have an impact or a significant impact, where everybody else was a little on the lower side. So if you find that 12% of the people, those are the ones you want to talk to, because they have a pretty good idea of what's going on. Resilience and opportunity and accelerated change. And that is kind of the key as we sat down and you think about the trends for 2021. There's new trends, and there are trends that were in place but got a tremendous acceleration from this. Well, we chose not to just focus on anything that was new. We thought it would be better if we actually identified the accelerated trends as well, because they're going to have an impact. And a lot of the acceleration changed direction as to what the trends were going to do going forward. First of all, as we think about it, what were people's attitudes? And this, this is a grain of salt chart for this year. This is when we ask people about their outlook for the next year and their ideas on profitability. And I think this is one where we see a difference between the countries in North America, between the US and between Canada, between a country that maybe has handled the outbreak maybe better than the other one. A little more very positive. 83% of the Canadian respondents think 2021 will be a good to excellent year. And I think that's a result of people seeing things getting back to normal, maybe a little faster, being able to transact, do business a little differently. In the US, it's 55% think it's good to excellent. And the number that think it's excellent is lower than the number that think it's poor. So there's a little bit of a difference there. And I think that reflects kind of what happened in 2020 in terms of dealing with the outbreak that's going to influence the next year. But as I said, this is one of those things when we started talking to people in July about the trends for 2021, attitudes shifted from the people we talked to in July to the people we talked to in August, September. A little bleaker, at least in terms of the outlook, just simply because there was so much in flux. Kevin, so what is changing? What's accelerated? What's, kind of a fundamental change? And we look at it. This is a quote that came out of the interviews, which I thought was, now is not the time for an always decision. And we've talked about this before, that this reliance on that's the way we've always done it is changing. So now as we look at this period of unseen change and what the future is going to look like going forward, what changes do we make? Should I reimagine my portfolio? Do I look at properties differently in terms of what they will look like coming out of the pandemic? What strategies will succeed now when maybe things are a little more uncertain than they were before? I want to know what's the right thing to do. This is, we asked this question because, when you think about, we're in this period of uncertainty, how comfortable am I making a decision for 2021? And that was one thing, when you're trying to ask people about trends going forward, the current period, definitely colors that. But, 44% still feel comfortable making decisions now, given the kind of conditions we are on. 10.10%, feel very strongly about it. So I think we're kind of at a halfway point. Some people are probably taking a little more of a wait and see. Some people are definitely moving forward with what they think is going to happen. The real question, and this was one that we debated internally as we were setting up kind of what do we ask people for emerging trends this year, is you had people that, are we talking about, pre-vaccine, post-vaccine, proven therapeutics, post-proven therapeutics? What does the next normal look like? Do we return to normal? And you kind of get this idea, but the one thing that overwhelmingly people feel very strongly that some of the changes that we're seeing due to the pandemic and due to the economic shutdowns that accompanied that these changes will be permanent. Not completely. It's going to be on the margin. We'll see some movement, but it's here to stay. So that's what made us feel a little better about, okay, we need to talk about those accelerating trends that were already in place, as well as anything that might be a fundamental change going forward. So, really the first place for this is, the property type outlook. If you're thinking about reimagining a portfolio, what do you think is going to be the winners for the next cycle? What do you think is going to be underperform? What should I be looking at? And clearly, industrial came out as a best bet. It was a best bet last year. It's a best bet this year. And the tailwinds behind it, I wouldn't be surprised if it was a best bet next year. E-commerce is clearly driving a lot of that demand, just simply because we are buying more things online. And that was one of the trends that got an acceleration during the shutdown. If you can't go out and shop, or stores are closed, you're going to buy things online. But going along with that is more traditional warehouse. And you kind of think about, okay, my global supply chain's disrupted by this. We're seeing it, we had disruption earlier due to the US-China trade war. That was disrupting trade, supply lines. people were looking at changing to different places in Asia. But now we've had a pandemic that's shown how bad that can be when I can't get product in, I can't sell things, I can't make things. People are looking at maybe reevaluating those. Part of it will be a benefit of that will be the new trade agreement between Canada, the US, and Mexico. I think we'll see more reshoring in terms of bringing production back closer to the final place of distribution. So that's going to be a little boost to that. The other one that comes up a lot, and we talked about 5G last year, is data centers. And that, as we've all moved to working remotely, think how much there's a data center somewhere running this whole virtual meeting, handling all the data as it goes back and forth. And then life sciences continues to be a niche product that is getting more and more attention due to the focus on finding a vaccine. We're all thinking about science much more than we were a year ago. And then the terms that it is an essential service that has to be done in a lab. You can't take your dangerous samples and take them home and work on them. Single family housing has become another focus. We're spending more time in our homes. People are thinking about what they want out of a home. Is it the same as they wanted before? Do they want to be in a denser area, or are they willing to go to a suburb? And single family rental. This is the first time in the survey that single family rental has been one of the top 5 property subsectors that people think will perform well in 2021. So that's all kind of evolving as we look at the results of the pandemic. And then multifamily is going to be there as long as we have affordability issues. People are thinking, okay, and the location of that is, we need housing. It needs to be affordable. We need the housing for different groups. And where will it be located? So once again, that's a best bet. And that's kind of the ongoing puzzle of solving the multifamily supply and demand situation. Office is a little bit, a property type in flux. I would say when the pandemic first started, we began talking to people, early on, retail, hospitality were clearly the product types that people were most concerned about. They were getting hit the most. Office has become more of a concern. And part of it is the remote working. Remote working has worked, to put it, kind of mildly. People understand the concept that it can actually function. So there's some discussion about, and we'll talk about this a little bit later, about how that's going to look going forward as people use office. One thing that jumps out as a best bet again is medical office. It's not going anywhere. Demographics are a good tailwind for it. We're seeing kind of a need to put it where the people are. So we're going to need more of it in different places. And so that's a very strong product type going forward. And then, retail, clearly, we've had the slides up showing the amount of space per person across the world and how it differs by country. Retailer bankruptcies accelerated due to the shutdown. You can't certainly an industry sector that was having some issues anyway, you can't shut it down and then have it go for that. And so we're seeing consolidation. We're seeing shopping center owners take ownership in retailers to keep the product mix going, which we'll see how that works out of those partnerships. But retail is likely to change. We're going to see this expansion of locations where you can have curbside pickup. So you can actually go into a store. People are going to be more laser focused about how they want to utilize a store, whether they want to be in there looking at it or whether they want to go somewhere else. And then niche products. I mentioned life sciences, a big one. Self-storage is another one. As we look at the way we live and we need more space, we all have more stuff that we have to store. And so self-storage is going to be the one. I don't know if I told this story last year, but somebody told me in the interviews a couple of years ago that part of the demographics and the wealth transfer from generations isn't all money. A lot of it is stuff. And so if you have the bureau that you got from, Aunt Susie, you can't get rid of it. You may not want it in your house, but you've got to keep it somewhere. So we're going to see the millennials are going to be probably the beneficiaries of a lot of products. 18-hour cities, 15-minute cities. And this is one of my favorite trends because I think it really hits on something that's been going on. And the 15-minute piece to the 18-hour really kind of fits, kind of what we've been seeing. And it's a good definition of that. And the flip side to that is, urbanization, do we think it's going to go away? No, I think it's still very viable, still going to be going on, but it may be in pause, and it may actually benefit from kind of this new way of thinking going forward. Now, as I mentioned, work from home works, and this chart kind of shows how many people were working from home before. Some were, not nearly as many. 82% primarily went to their external workplace. During the pandemic, we saw the shift. People began working from home, and it worked for the most part because of technology like we have today. If you think 10 years ago, I think most of us would have cramps in our arms from holding the phone to your ear all day trying to do this. It would have been virtually very difficult to work from home. Now, you can do meetings. Who would have thought that we could have had 600 people sitting here participating in a meeting, just even a few years ago? After the pandemic, companies have seen this works. They're going to allow more people to choose this. Work-life balance will improve. People won't spend as much time commuting. Well, if you're not spending as much time commuting, do you think about maybe I could live further out where I can get more house for my money because I'm not going to be making that commute every day. I'm only doing it on a certain time period. So that's kind of changed as this kind of evolved. Initially, I think people were thinking, okay, this is working great. We're not going to need real estate at all. But as this has gone on, I think they're beginning to see the shortcomings of the kind of the mix. And people still like to get together and kind of talk, and the benefit in that. So that's increasing. And so we're going to be moving to that happy medium. And it'll take identifying functions. Some functions work better remotely than they do in the office. Some you need to be in the office. What do you need for equipment? What do you need for space? So before, when we were kind of moving to this all collaboration, everybody getting close together, more, for lack of a better term, packing more people into the space, that's going to change a little bit. I think that's going to move. But does it mean we're going to use less space? Not necessarily. Even though most companies are going to allow people to work remotely more, this 94%, it doesn't mean that they're eschewing the office altogether. Because 64% feel like office space could actually rise with the increase in remote workers. And part of that is because of the social distancing. We're thinking, okay, we need more space per worker. We're social distancing. We're managing things differently than we did before. Maybe we need different spaces where people come in. Maybe we need more larger areas where people collaborate. So the office isn't going away. The office has been in place since the 1700s. It's still serving a function, and we'll see ebbs and flows of people. One of the things talking about is people are thinking, okay, and it's going to be a whole nother cottage industry, is managing the movement of remote workers if you have more people doing it. Here's kind of the 51%. This is interesting, but in the next 3 years, how much do you think you'll need? Less office space, more office space, or the same? And 50% think they'll need more in 3 years. Part of that is that idea of I need more space per worker because I'm going to be social distancing people. The other part of it is that they think things are going to grow. So they're going to need more just through organic growth. What about the urbanization then in high density locations? And this was kind of an interesting question. And this you get, it's 43%, so it's not 50-50, but it depends on who you talk to. There are people that feel very strongly that we're going to see more move to less dense areas. And there are people that feel like once everything opens up again, everyone will come back to the urban core and want to be there. And you can see the point on both sides. And I think, the urban cores are the center for culture, entertainment, finance, usually education. So people are going to want to be a part of that. And demographically, we've talked about the millennials making the move further out for more space. The next generation is going to be following in behind them. Not quite as large, but they'll begin to take that space too. So not everybody is going to abandon the urban core. So the 18-hour city, and this, we've talked about it in the US, and we've not spent as much time talking about it, in Canada, simply because of the strength of the urban core in most of the markets. But you look at it, similar amenities, you have a little more space. Once again, you may still work in the urban core and decide you want to live in a 18-hour city. Or the fact that you can work remotely and work from anywhere, you go, okay, this is fantastic. I want to live here. I can still work there. I don't have to switch employment. Just that flexibility is going to lead to more mobility and ability to do it. And some of, in Ontario, Kitchener, Waterloo, London, and Ottawa, kind of cities that came up as fitting the kind of that 18-hour mold. Now, the 15-minute city this is one that I think I've heard about it in, kind of markets like Dallas, Fort Worth, Texas, huge sprawling areas, but they have these suburbs that you can get anywhere in 15 minutes. Now, this definition says walking or bicycling, but they think of it as car. If you can get in your car and get somewhere, park, walk in, be out in 15 minutes, that's a successful kind of almost urban-like suburb. So I think as people see these neighborhoods that you can do the 15-minute ideal, then we're going to see kind of the expansion of the live, work, play model that works so well in the urban core begin to work in other neighborhoods across the country and around cities, kind of creating these kind of vibrant hubs. And ideally, maybe vibrant hubs that are connected by mass transit so people can go from place to place, just kind of creating that mobility. But this is going to be an exciting change going forward. There'll be some pioneering locations that people can begin to look for. Technology. Technology isn't going anywhere. Technology may shift its focus a little bit as it begins to look forward. The necessity versus FOMO. And I have to admit that it hasn't been that long. I had to look up what FOMO stood for, but fear of missing out. So rather than going and getting the newest thing because I feel like everybody has it, I want to have it. What technology can I put in place that's going to help my business? Because let's face it, we haven't had a severe recession yet, but we've definitely had a moment to stop and think about how can I be more efficient and build my business. Future use of technology going forward. This was a question we asked, early on in the pandemic. 93% believe that they'll see more technology use in their company because of the pandemic. And I think a lot of it is related to collaboration, being able to work remotely. It's going to fit into that. Where are leaders prioritizing their investments? Optimizing data analytics. We have more information than we had before. We're getting serious about how do I use that to make better business decisions. And it fits across you think of any industry, and it's hard to find one that would not benefit from this. Leveraging automation, kind of the idea of doing more with less, work, not necessarily replacing workers, but augmenting workers so that they can do more. So when a person is talking to someone on the phone, they have all the information they need. It just pops up automatically. Moving to the cloud, where we can do fits with work from home, working remotely. We can do things anywhere. So these are all kind of things that not necessarily enhancing real estate, but it definitely enhancing the way companies are working, and real estate will be a part of that. From a real estate perspective, construction technology is still very high on where we think real estate use of tech will go. And we're seeing that in terms of efficiency, managing labor better, new building products that are better for the environment, doing things better in terms of that. We get more information, so we're going to have to protect that. And there was a story in the news yesterday about cybersecurity and hackers getting into hospitals to get information. So anywhere there's information, there's a danger, and it needs to be protected, and that's going to be a focus going forward. So the policy imperative, what do we need to think about going forward coming out of the pandemic that maybe we didn't? And immigration is a perfect example. I was on a call yesterday and they were talking about immigration policy and comparing kind of the strength of the tech market in the US to Canada. And one of the advantages of why cities like Toronto and Vancouver have excelled and probably are doing a little better than the tech centers in the US is immigration. A more open immigration policy, which obviously has suffered during the pandemic, needs to be opened up again so that people can come in, and it drives economic growth. And there's a chart in the report that I think illustrates this very clearly. And it's one that came up in discussions in the US as well, is that a lot of the gateway cities depend heavily on international immigration to support their growth. They've been losing population to either the suburbs or other cities for years, but that's been backfilled by immigration. So that needs to go. In terms of getting projects and houses, or from the housing perspective, faster approvals. I think we may be on the cusp of perhaps technology being able to enter into that process to make that smoother and easier as we go. And then taxes. The pandemic has come with a fiscal cost. It does cost money to battle this, and cities are seeing they're seeing a bill to battle the pandemic and provide services, but then they're also seeing a loss of revenue in terms of sales tax revenue, or property tax revenue go down, income tax revenue, things all lowering. So we have to make sure the real estate doesn't become kind of the piggy bank that you turn to for that. Certainly the industry is more than willing to pay its share, but it kind of needs to be balanced out and not seen as, okay, we can get it from there. And the rise of ESG. This has been a very interesting year, and perhaps would have been more of a story if we had not been going through a global pandemic or in a health crisis, is environmental social governance investing continues to rise. We've been talking about it in emerging trends probably for at least 3 years, and it might be more, but this year we've got wildfires, we've had a record number of hurricanes in the South Atlantic region. We had the social unrest in the US due to systemic racism and social inequity. And that's all kind of building up, and people are thinking about, okay, I'm going to invest due to ESG. And we've hit a point, and we've talked about kind of that tipping point where ESG proves itself out, or the proof is in the pudding, where the returns are there. And we're getting more information on that. So that continues to rise. It's good. It's good from perspectives of investors looking for it, and it's good from companies thinking about it and implementing it. Everybody benefits from that. Well, that is my opening remarks. Like I said, a very unique year. Thank you for everybody that participated again this year. I know it, in some respects, it may have been easier. It may have been harder, but we couldn't do it without all of you. So thank you very much for that. And then I'm sure the panel will give you a very, very more detailed step into kind of what we're looking at for here. So, well, thanks again. Even though I couldn't actually come to Toronto, it was a pleasure to be able to participate. So thanks very much.
Thank you very much, Andy. On behalf of the Management Committee, I'm echoing.
Maybe
Cindy,
I'll take over.
We can't hear you.
I'll quickly take over just to keep things going. But
I think, Richard, can you hear me now?
Yes, go ahead.
Sorry about that. So thank you very much, Andy. On behalf of the Management Committee, I really want to extend our appreciation for once again presenting the annual trends report here in Toronto, for managing the virtual technology so capably. Our large audience here today is testament to the high level of interest in your report, which of course is written in cooperation with your colleagues here at PwC Canada. So it's now my pleasure to introduce Miriam Gruzer, partner of PwC Canada, who will introduce and moderate our Toronto response panel as we further explore the emerging trends in real estate for 2021. Miriam is the Managing Director in PwC Canada's National Real Estate Consulting Leader and Vice President at PricewaterhouseCoopers Real Estate, Inc. She is currently spearheading the Data Analytics Initiative with a focus on the real estate industry. Miriam brings a unique perspective and experience in data analytics, financial investment, real estate systems. She's been involved in reviews of all classes of real property and has provided advisory services to public sector entities, pension funds, institutions, developers, property owners, property managers, and asset managers. She's also one of the senior advisors of the Emerging Trends in Real Estate report. We couldn't think of anyone better to lead this conversation for us, Miriam. I'll pass it over to you to introduce our panelists.
Thanks, Cindy, and good morning to everyone. Today, I have the pleasure of being joined by our panelists. I'll present a brief bio and then we'll start our conversation. We are joined by Renee Gomes, Ali Wolf, Ray Wong, and Jeff Smith. Renee is a registered professional planner and Chief Development Officer and VP Development at First Gulf Corporation. Her experience includes complex master planning and municipal approval initiatives in Toronto's waterfront, across the Greater Toronto Area, and in England. She is a board director of Evergreen and a member of ULI Toronto's Management Committee. Ali is the Chief Financial Officer and Global Head of Portfolio Management at Oxford Properties Group. Ali leads a team of over 200 professionals responsible for capital allocation, finance, strategy, research, tax, treasury, and risk. Ali has over 18 years of real estate investment, finance, and advisory experience and has worked on over $50 billion of investment and financing transactions in Canada, the US, Europe, Asia, and Australia. Ray is the Vice President of Data Operations for Altus Group's Data Solutions team, overseeing 60+ researchers across Canada. Ray's primary responsibility is to ensure data collection is all-encompassing, reliable, and accurate, and that it adheres to the Altus Group data governance guidelines. Ray regularly presents on key market trends to clients and at industry events. And then Jeff is the President and CEO of Ellis Dawn, an employee-owned $5 billion a year construction service company, and has grown exponentially beyond its modest origins in London, Ontario. Jeff earned his law degree from the University of Toronto and has served as a curriculum advisor to Ryerson University, chaired the Technology in the City campaign for George Brown College, and serves on the board of the Canadian Council for Public-Private Partnerships. Welcome and thank you for joining us today. If there was a common theme in our interviews with real estate companies this year, it was uncertainty. We found diverging views on several important issues, ranging from a potential uptick in suburbanization to long-term shifts in office vacancies due to remote working, as well as the outlook for Canada's recovery from the COVID-19 pandemic. Can each of you give me a 1-minute response on what you think is the biggest impact COVID-19 has had on the industry? We'll start with Ray, then Renee, then Ali, and finally Jeff.
Thank you, Miriam. The good news is that the pandemic has showed us that we can all quickly adapt and innovate, especially from working remotely. And COVID-19 has and will fundamentally change the way we interact with real estate, but the real longer term impact is still soon to tell. And we've seen some sort of near term impacts, such as increase in sublet space in the office sectors across Canada. But some tenants are still weighing out what the strategies are. And that's why we've also seen sort of a delay or a major slowdown in the lease activity. You know, for investors, there's still activity is still occurring. We're only down about 20% investment activity year over year, and they continue to scrutinize their forecasts and returns, as well as review their existing portfolio for potential risk and opportunity. So a lot is still remains to be seen over the next 12 to 18 months.
I agree that we don't really know what the impacts are yet. So rather than commenting on what I think the single biggest impact is, I'm going to say what I think the biggest impact should be. And I think that's an acknowledgement among all of us that unpredictable, disastrous shocks are going to happen, and they are not all going to be pandemics. It's not going to be another 100 years before the next disaster happens. And in order to have our best shot going forward at responding to these kind of shocks, we really have to pivot towards building truly resilient cities. And I think, you know, prior to COVID, there was a growing awareness, but perhaps not quite a full understanding of what building resilient systems and communities really means. And this is hopefully for those of us who are best positioned going forward, it's going to force us to come to that understanding and make that change.
A great comment, Renee. I think we know that it's not just a short-term impact, but rather the permanent impact on how we actually interact with real estate, and that our values with real estate have changed. And so what I mean by that is I think of what are the lasting impacts of us getting used to online shopping and curbside pickup, and how is that affecting the relationships between the shopper, the retail, and the landlord. And it's going to look very different in 5 to 10 years, and we know the shift is already underway. I know we're going to talk about the future of office, and it's hotly debated. And it's going to be hard to imagine that even after the pandemic, that our employees and our team members aren't going to want to maintain some component of work from home flexibility, and how we look at open space and amenities differently. And, you know, speaking to, I'm sure a lot of folks on this call were active business travelers before the pandemic. And I have to say that's one area that I don't miss, and it seems to be a common sentiment. And then finally, what was touched on the previous discussion was just where we live may change. And we're seeing increasing number of people moving away from the extreme density of urban cities to locations that are more open and space, and providing a different quality of life. So what we value, you know, we used to value being in the hot urban centers and the action. Those values seem to be shifting. And so that's really the biggest risk we see, and the questions that we're asking ourselves, and how do we adapt as real estate investors to take that into account.
Good morning, everybody. Jeff Smith here. Let me give you the news from the construction front. The first wave, we saw about a 20% decline in productivity, and the same kind of relevant schedule impacts. I'm really worried that the second wave is likely to be worse. We've seen more cases on our sites in the last 6 weeks than we had in the previous 6 months. And as you know, it can shut down an entire site. We've got to be, and the cases they're coming to the sites, of course, from the bars and idiots carpooling and things like that. But there's a real disruption happening out there. It's affecting the supply chain. All of a sudden in Toronto, there's a concrete shortage that is COVID related that we didn't frankly see coming. And longer term, we're really worried about a disruption to the subcontractor supply chain. They're not getting any COVID relief from anywhere, some from queues, but other than that, and I think going forward, there will be fewer subcontractors. So in the short run, the price inflation, I think you've all hated from the construction industry in the last few years, will die out. If you're brave enough to go ahead with projects in the next 12 months, you'll get some good pricing. But after that, I think the supply chain is really going to be thinner. The consolidation that was happening in construction is being accelerated by this, and that's not going to lower your costs. So short term, some relief on costs, but more second wave COVID impact, and longer term, not really any good news. So we're getting whacked out there a bit. That's how I'd summarize it.
Really interesting perspectives. Building on that, to quote a famous saying, necessity is the mother of invention. A global pandemic definitely created a need for change, and we're seeing already existing trends accelerating. One area is redevelopment opportunities, or reimagining, in particular to support changing needs. One example, we heard about our retailers reallocating space for in-store curbside pickup, residential builders allocating common areas to office use, and others. How are you pivoting your development strategies, and are there areas or amenities you're focused on for your developments, either in the suburbs or in city centers? And I'll start with Ali, and then we'll move to Renee. Certainly, and I did have a chance to talk to our development team just to hear kind of what's happening right now from their perspective. And so I think on the residential side, we've already been including high quality co-working spaces as part of our package. However, the teams are reviewing layouts and looking to see if they should be revised to keep in mind kind of more separate stations and more augmented and open arrangements. I think we're also looking at our unit mix and looking at to see the idea of dens and nooks that would actually accommodate perhaps a bit a shift in work from home. And then I think we're also looking at ensuring, do we have sufficient outdoor space? So projects that had limited numbers of balconies are being revised to include more balconies, as well as looking at kind of outdoor terraces and looking at those amenity spaces differently. I think on the retail side, obviously,
there's been a shift, and we've seen this from kind of more traditional merchandising strategy away from fashion tenants and more to alternative uses. And I think, that was an area that was already occurring, but the spectrum of alternative uses is continuing to evolve. So that is looking at areas with medical, education, wellness, and beyond just your kind of traditional alternative uses in the retail space. And we're really working hard to partner with our retailers to make the best of their retail footprint and to facilitate the curbside pickup, to look at implementing digital solutions to help them manage store lineup. So I think one of the things that's been great is the partnership between the landlords and the retailers to help make the most of the situation and accelerate, to be honest, trends in the direction that we were already on.
Renee?
Yeah, I agree with pretty much all of that. My colleagues on the high-rise side, they're definitely starting to see increased demand for outdoor space. So for example, increased demand for private spaces like balconies. And obviously, I think we're going to continue to see demand for additional workspace at home. So that might mean dens, and as opposed to just traditional one-bedroom units, and the shift possibly away from just completely open format units to spaces that allow you to go somewhere and close a door if you are living with other people. And as people might have predicted, we're obviously continuing to see demand for low-rise product, but I think what's important to highlight is that it doesn't necessarily mean that high-rise and downtown development is completely going to disappear. We certainly don't think that, particularly in the GTA. The product may obviously differ in higher density areas, and the built form is certainly going to evolve, but if you do think about Toronto in particular, we have a lot of faith in the region and its long-term role as a center of immigration and growth. And when it comes to people thinking that all of the demand is going to shift towards low-rise product, I think that's going to continue to be mitigated by the issue of affordability. And on the retail side, I would echo what Allison said, that I think what we're starting to see is an acceleration of what was already happening. That industry was already starting to be forced to transform because of the rise of e-commerce, and a total transition is going to happen now.
What about niche sectors? Diversifying assets can be important to preserve value. Are you seeing a change in focus to niche assets, and if so, which ones? And I'll start again with Ali, then Ray.
Yeah, it's a great question. So, and it's interesting because I think what we've heard is we've grouped things into alternatives, and I think what we'll probably see is that perhaps in next year's trend report, some of those alternatives will be their own categories. And so we're seeing things like studio space. So one of the areas where you're being stuck at home and the content streaming of Netflix, or if you have kids, Disney Plus or Prime Video. The desire for content. And so we're seeing that as an area where increasing levels of interest on the institutional side, and we're looking at it from both a credit as well as an equity perspective. So as we start to look at some of these alternatives or kind of adjacent to the traditional retail sectors, it's really just reflecting consumer demands. And so I think we're going to continue to see increasing capital flows and institutionalization of these assets.
Ray?
Yeah, and just sort of echoing Ali's comments, especially with consumer demands and how demographics we're already making these changes, especially with the retail sector and how we interact with the space. But again, what was said earlier with the acceleration of the changes, there was already discussions about the focus on cold storage facilities, especially with the growth in grocery online and data centers. But the focus is as well on intensifying uses on existing properties, integrating the retail, the office employment, anything that creates a certain element of synergies, and as well as creating values with some of the older assets. So I think we're going to see a lot more sort of look at how the demographics are changing, the churn with some family composition that will move to suburbs for more space. But again, the urban environment offers restaurants and amenities for the millennials still, that now with perhaps our decrease in rental rates can allow them to actually move back into the urban market. So I think we're going to see a lot of changes with alternative assets based on what's happening with e-commerce and as well as the tech sector, but as well as more focus on increasing the value and the density of existing properties as well.
Thanks, Ray. Really interesting around studios, I must say, because we all do have the insatiable appetite right now to be watching all kinds of shows and streaming. It's going to be a challenge to consolidate this smaller asset class into something that's investment size, but we've heard that several times in our interviews throughout this whole process. We've talked about the 18-hour city in past years, but one of the new trends in this year's emerging trends is a shift to 15-minute cities, as Andy mentioned, where everything needed is a short bike ride or walk away. This reflects not only the impact of COVID, whereby people may not feel comfortable venturing out too far from home, but also possible longer-term desire for a closer connection to the immediate community. So is this a trend you see developing out? And if so, are some examples of what are some examples of your strategy to satisfy these market trends? And we'll start with Renee and we'll move to Jeff then.
Sure. I actually think there was already demand for the 15-minute city before COVID. And as you mentioned in your introductions, I'm an urban planner, so that's always going to color my remarks. And for me, the concept of a 15-minute city is really just a rebranding of what planners have always called complete communities. And that's basically just the idea of transit-oriented, mixed use, mixed tenure, mixed density neighborhoods where you can walk and bike to what you need. And really good planning policy has already been encouraging that for the last 15 or 20 years, especially here in Ontario. So considering the GTA context, anyone who is familiar with the growth plan, which is our long-term provincial policy, you'll know that it's premised on the idea of a region that's defined by a number of centers and corridors, not just focused on downtown Toronto. And the 15-minute city concept really does fit in well with that. I do think, though, that we all have to acknowledge that you do have to be in a center or in a corridor in order to fully get the benefits of a 15-minute city. In very low density areas, the potential to achieve walkability is going to be limited because in a context where you're relying on walkability, you need density to support viable businesses and amenities. So there's going to have to be some balance there.
Jeff?
Miriam, the first time I heard the term 15-minute city was when I got your questions for this panel discussion. So that just tells you how I'm not the coolest guy on the panel, all right? What we're seeing, but when I thought about it and sat back, I thought that's not what we're seeing so much. Of course, we only see what all of you give us. So let me just tell you what I am seeing. It's more about repurposing existing assets that aren't working so well to try and make them work better, whether for the purpose of a 15-minute city or just others. So we're seeing existing commercial and industrial go to data centers. Andy mentioned that a little bit. We're seeing empty warehouses being repurposed to another cool term I just learned, last mile logistics, which of course is all about the boom in online shopping. Older shopping centers being repurposed to multi-use. I don't need to tell you about that, but it seems to be being accelerated now. And big commercial projects that we'd already priced and budgeted for clients are now coming back to us as going away from commercial, or at least a big portion of them is switching over to res. So those are kind of the trends we're seeing. One other trend may or may not be relevant for you all is a pretty big increase in institutional construction. Not relevant for the development industry except around costs. So that if it takes up the slack in the construction costs, then the cost savings I promised you about 5 minutes ago may not materialize. If the feds really come through with infrastructure stimulus spending, that may have an impact on how we can provide our services. Andy mentioned mission critical. We call that data and pharma, a lot of that. Commercial, surprisingly, big projects on hold, but not dead. We're still getting commercial awards. Big residential uptake. I don't need to tell you about that. And the last thing, we're seeing projects becoming much bigger and much more complex. For us, something less than $100 million project is now a novelty. That means fewer suppliers, and it's just a trend we're seeing out there. So that's kind of what we see at the from our lines.
Thanks, Jeff. Okay, let's talk politics. Last year, we talked about a black swan event, as Andy mentioned. I don't think anyone thought it would be a global pandemic. Combined with the social unrest in the US and the election next week, there's a general sense of unease. How are you or your clients' investment strategies changing? Are investments in the US and global markets favored? And if so, please be specific. And I'll start with Ray, then Jeff, and then Renee.
Well, unfortunately, this pandemic has really adversely impacted the ones with little or no savings, and especially the service and the hospitality sector. And that sort of, and the longer we have businesses shut down in different phases, the more impact to owners' survivability. And that sort of has a cascading impact with respect to the actual rents and the collection. And that's why the whole retail sector is getting it's getting a lot more focus. But it's interesting that when you look at the overall investment activity, is the retail malls and shopping centers that really dropped in activity, whereas restaurants and individual retail has actually increased over last year. So the good news, it shows liquidity. The bad news is that there might be sort of a push in that area that they have to sell. So it's an area to watch. And what was mentioned earlier, the steady demand in storage and distribution, storage space. And we've seen a couple of office buildings in Toronto that got converted into storage space. So I think we're still waiting to see what the longer impact and the survivability of some of that retail. But I think it's the longer this lasts, the more adverse impact it's going to have on real estate, and especially with rent collection.
Jeff?
Oh, sorry, I'm next. Listen, the point I wanted to make here is the upheaval that's happening, and politics relates to it because, as I mentioned earlier, the construction industry hasn't been getting any relief. And I'm talking about our supply chain primarily. I'm really not whining, but thinking about how it's going to transform things. So again, what you're going to see is not just fewer subcontractors, but I think a transformation of the construction industry with fewer players, with therefore much more vertical integration. Elliston probably won't be able to go out and get 4 or 5 mechanical prices 2 or 3 years from now. We may price the mechanical ourselves. So the way construction services and schedule and price certainty is delivered to you all, I think is going to be transformed. And of course, software and prop tech and IT, Andrew mentioned this, I'll just make the point. Everybody says we need to make it more efficient. When you're looking at it and the way you deal with us, don't look at the construction industry the way it was 5 or 10 or 15 years ago and try to make it more efficient, because 2 or 3 years from now or 5 years ago from now, it will not be the same. So we need to work together on how that IT and that software works to give you what you need. But it's not delivering the same thing more efficiently. It's about delivering something else entirely, or the same thing in a completely different way. So that's the point I wanted to make on this one.
Renee, where U.S. and global markets favored?
Yeah, so our family of companies is already very active in the U.S., and I expect that that's going to continue, particularly on the residential side. I think there's certainly a temporary period of instability in the U.S., but that's not something that we think is going to persist to the extent that it would make us want to exit that market or markets within the U.S. The one thing that I think is going to be a challenging factor is when we are looking at new submarkets. Obviously, in the interim, our ability to actually go out and see sites and do business is going to be impacted, and we are not going to be making those types of decisions virtually. In real estate, ultimately, you do still want to see your product. And as my president said, I'm not going to buy land on the basis of what I see on Google Earth. So we need to get to a point where we don't have travel restrictions anymore before we can really see what the impacts are going to be.
Sounds like we're a ways away from that. But turning to a more local perspective, the pandemic has put Toronto's economy on a weaker footing this year. What impact will rising consumer debt levels, reduction in government aid and incentives, and even the rising government deficit have on the real estate supply and demand levels in Toronto? And we'll start with the same order, Ray, Jeff, and then Renee.
Well, industrial still gets positioned as great opportunity for investment. Overall investment activity is actually up compared to a year ago, but it's a small bay industrial that we're seeing an impact. And again, that's related to the type of tenants in those buildings that are catering to the hospitality and the niche retail sector, and we've seen a number of closures and adjustments in that area. So again, with the reduction in the government aid and incentives, I think that's where we're going to see some challenges with some of these tenants surviving. And again, it really depends on the time length of these closures and the survivability. But on the positive side is that we are seeing other sort of retailers hit the market. So from a supply and demand perspective, we all know about what's happening on the retail side, and there's some less of an impact on industrial. Industrial is still quite strong based on the warehouse and e-commerce, but some of the smaller bay industrial we'll probably see a bit of an impact, but also expansion on the warehouse space for third-party logistics companies.
Listen, Jeff here, I kind of jumped ahead to that part of the question in my previous comment. So the only thing I'd really add to that is still a really strong demand generally or a reasonably strong demand for construction services in Toronto and across the major cities in the country. So we're really focused on that. The thing that I'm worried about, in addition to the other worries that I've already outlined, is there's a terrific, I'm going to say the word manpower because I haven't got a better term for it, shortage at the tradesperson level in Toronto and in Vancouver and in the major cities. There just aren't the number of people, and I'm talking at the tradesperson level, and we're short by thousands to deliver on the demand for the projects out there. And it's a failure of the industry. It's a failure. It doesn't matter. It's out there. And that's going to affect supply at a time of reasonably strong demand.
Jeff, I would imagine that immigration and the lack thereof has also impacted that in quite a significant way.
You wouldn't be surprised to hear me say that we are big fans of immigration. The more we can put these people to work as quickly as you can give them to us. The unions would say the same thing, but we'll train them, we need them, and of course it stimulates demand as well. So absolutely.
Renee?
When I was talking about this with my colleagues, one of them pointed out that it's important to highlight that we're still in a pandemic crisis. So we don't know yet the extent to which that's going to translate to an economic crisis, and what steps governments are really going to take in response to that in the longer term, and to what extent those government decisions are going to leave us competitive or not competitive with decisions made in other markets. So I think there's some extent of unpredictability that remains there. I think obviously some people are expecting increased taxation, but whether that's direct or indirect remains to be seen. And then the other thing I think we can't say with any degree of certainty is that there will be reductions in government incentives. I actually think ultimately some form of incentives and aid is going to be critical to recovery. And in a city like Toronto, for example, they may determine that it's necessary to sustain or ramp up existing incentives that they have in order to promote investment in the city center and office development downtown. From the development side, I also think it's really important for people to remember that incentives do not have to be financial. Approvals and policy-related incentives for the development community are really important and can have a big impact on stimulating our business. So those options remain on the table, I think.
Yeah, great ideas. Let's talk about remote working, a hot button issue right now. This was an area of significant divergent views. We did a recent pulse survey that indicated only 30% of Ontario employees were comfortable returning to the workplace, yet some of our interviewees thought this was a short-term trend. There's a potential for two fundamental impacts. The first on your day-to-day business, as well as the effect on your development and investment prospects. What are you seeing and predicting? Let's start again with Renee, and then Jeff, Ali, and Ray.
So I definitely think, well, as I mentioned earlier, what we're seeing is we're starting to see changes in both the low and high rise when it comes to residential. And I think there will definitely be some jobs that become completely remote, but I think the overall landscape of employment is going to become a lot more nuanced than just a simple shift from working in an office to working from home. So some examples, and Andrew touched on these, are like fewer employees in the office, but lower employment density, which means you are not necessarily going to see space reductions. There was also the significant potential for growth in suburban office, of companies choosing to have their own campuses, and more of a shift towards the type of office development that we may have seen in the 1980s and 90s. The potential for flexible arrangements in which people are spending some of their time at home, but also some of their time in the office. And so my personal belief is that in-person interaction is not going to disappear completely. I think there are too many industries that depend on face-to-face interaction, or too many facets of all of our industries that still depend on that. And I think most people would agree that human nature just tends towards that anyway. And I think a couple of examples of why a sizable component of our work remaining in person are related to the fact that in recent years, especially in Toronto, we've heard so much about how knowledge-based industries and tech are drivers of our economy, and that they are very dependent on, I think it's called like unplanned collisions, and spontaneous interactions where people generate ideas through that type of interaction. And that type of activity is practically impossible to have online. The only interactions that you have online are planned and very structured. And so spontaneous interactions, networking, all of that kind of thing is not going to happen in a totally virtual economy.
Miriam, I'll just give you a quick micro view of this. Most of Ellis Don's offices are back, actually, about 78%, 70 or 80% occupied safely, except Toronto. I guess that makes sense because that's where the cases are. But Toronto, that's where people just don't want to come back to work. We're about 30, 35%. We want our people back. We've got offices, of course, across the country. We don't see cutting them at all for the reasons that Andrew mentioned. Maybe more working from home, but greater space requirements. So we see it as balanced on a square foot per person basis. It does working from home, but I tell you what, we don't like it. And we've had a couple of employees say, gee, I really like this working from home part. Do you mind if I work from home for the rest of my career? And we tend to say, we don't mind it at all, but you got to go work for somebody else, because it's just not the way you build a company. So we're more optimistic about office space than you might hear out there, based on our own micro experience.
Yeah, I couldn't agree more with Jeff and Renee. I think once we address, the immediate safety concern, because I think that's part of the challenge about people coming in, and that's going to happen. So, and particularly in urban centers where a big component of our employees take public transportation, there's just not possible to kind of physical distance. But I think we're going to get through that period. And I think one of the reasons why we've been able to effectively work from home is that we've had 5 and 10 or 15 years of working in the office, building relationships, building culture. And so we've been able to carry that capital, that culture capital and those relationship capitals through this very challenging period. However, it is really hard, if not impossible, to build culture over a Zoom screen. And it's really hard, us that are later in our career, we've had 20 plus years of having a chance to be in the trenches, working side by side, learning the culture, learning the trade. And that's really hard. So when I look at the experience of folks working from home that have been part of the company for a while, who have deep relationships, not only with their colleagues, but also with other people in the industry, we've been able to lever that to make this as efficient and as productive as possible. But when I look at some of the employees that we've had to onboard during this time, that's a very different experience. And so I think we are, you know, the downside is we're going to have to get out of our track pants, but the good side about going back into the office is, you know, we're going to be able to help continue to build that culture, help continue to be able to train. And, you know, as Renee mentioned, when you look at those social interactions, so bumping into people, not only in the office, but at the coffee shop or at the local restaurants. And so just touching on your previous question with regard to, you know, I think supporting our small businesses, our restaurants, and our retailers are absolutely critical, because if you start to see and you're seeing accelerating failures, what is the benefit of being in a vibrant urban city in Toronto if our restaurants are no longer there and our coffee shops are no longer there and our small businesses are no longer there? And so I think that's something that we really need to continue to support as we work through this, you know, this pandemic period.
And I agree with all the comments. I'm a big believer of the viability of the workspace, and as well as downtown, just based on the amount of amenities that are available with restaurants and retail. But with Ali's point of just, you know, that they can actually survive during this sort of second wave. And Renee's comments earlier about that movement of office to the downtown to the suburbs, even though we've seen most of, if not all, the sublet space occurring in the downtown, especially with Vancouver and Toronto, we haven't seen the increase in leasing activity in the suburbs. We've probably seen a lot more sort of inquiries, and a lot of that, especially earlier on in May and June, it was basically they wanted something that they can actually walk up to their office instead of taking an elevator with 3 other people or walking up 50 floors of stairs. So there's that element, but with suburban office, it's sort of like it doesn't get the same amount of attention compared to the downtown. But it's interesting with Toronto suburbs that over the last number of years, they've been averaging close to about 500,000 to 1 million square feet of space, but it's in small chunks and small buildings, and for tenant-specific uses. So it doesn't get a lot of attention, but it still gets that demand. But at the same time, the Toronto suburban vacancy rate is 10% versus Toronto downtown at 5%. So I think what we're going to look at going forward with the office space, and I agree with the whole flexibility with being able to work from home, but as well as the flexibility within the space. So I think Renee's point earlier that the average square feet per employee will probably increase because of the need for social distancing, but the actual footprint I think will shrink a little bit just because of the hybrid workspace. But I think that's where you're going to have, and Oxford's done it, and the WeWorks and the other companies of creating flexibility within the buildings to allow companies to either grow or shrink, and especially for not having to commit for 3 to 5 years of that space and be able to adapt quickly. So I think going forward, the co-working space is going to be more and more of an amenity that tenants are looking for to create that flexibility in the workspace as they grow or for specific projects.
Great points. The increase in remote working investment in prop tech tools and technology and higher adoption of smart home technology has also increased cybersecurity and data privacy vulnerability. So what are you seeing in new innovations that are emerging to address these risks? And Jeff, from a construction point of view, and then Renee from a developer's point of view.
So really quickly, because I've got more to say about your follow-on question in a minute, but around cybersecurity, we're just following the trends that you'll see and that Renee will talk about. It's interesting, however, around the cyber and therefore physical security around construction sites and how they're almost becoming, I don't want to, very secure facilities that you have trouble getting on and off. There's cameras everywhere. It's the one area where cybersecurity is hurting productivity. The only area that I've seen. And I realize that's not exactly the answer to your question, but I just thought I'd note it, and I'll come back on the other one in a minute.
Okay, Renee, around cybersecurity.
I talked about this a little bit with my colleagues, and what was interesting is that the prevailing attitude seemed to be that so far there are no innovations that seem to be able to keep up with the pace of fraudulent activity to a point where it would give us confidence to make major shifts towards remote working or completely different ways of doing our business. So most of the changes that we are seeing in the interim in that area are like the opposite of tech-based. So for example, prior to certain transactions being made, we now have a policy of verifying banking information by telephone calls and just speaking to people the old-fashioned way. So I think the risks associated with hacking are so significant that there's a lot of skepticism about the idea of new innovation being able to protect privacy. We really need proof of concept there before there's going to be a complete adoption.
Sounds like a long way to go. So just for a follow-up question on that, this year's ETRE reports that investment funding in prop tech is expecting to see a slight dip this year, and the areas of investment are shifting towards tools to support more practical, tangible applications, such as the use of data analytics to gain insight to support changing strategy and to respond to immediate operational needs. How has your investment and adoption of technology changed? And I'll go to Ali first, and then Jeff.
Thanks, Miriam. Yeah, no, this is a huge focus area for us at Oxford, and we've made pretty significant investments. And we're actually looking at this across multiple processes, both from an operational perspective, from investment perspectives. And so just a couple of examples. You know, we've always set daily energy and carbon targets since 2015. And really, this year, we've been able to use data and analytics to be able to really analyze data at such a granular level and monitor our kind of carbon targets hourly versus daily. So we've been able to really optimize aspects just with the advanced use of kind of data and analytics. We're also doing a lot of work with regards to analytics around how we optimize and look at our overall investment strategies. So I think this is an area where you're going to continue to see significant investment and really have a chance to benefit from using the new technology to advance and accelerate all areas of our business. I know Jeff will talk about how it's being used on the construction side. We're looking at it from the operations side, you know, even looking at it with regards to working with our tenants. So I think it's really exciting, and real estate's probably been one of the industries that's been a little bit lagging in this area. And I think you're seeing some pretty significant acceleration this year and in the years to come.
So I'll just add a couple of comments. This for me is the area that I'm most fascinated by. I saw a speech by the CEO of OpenText about 3 or 4 years ago. He said, in 5 or 10 years, if you're not a software company, you won't be a company. And so we are determined. We're investing very heavily in construction, IT, and analytics. We've got about 75 programmers sitting at Elliston because we need to control our own core business software. I think we'll lose control of our business. But back to what I touched on a few minutes ago, I believe anyway, that design software is going to merge with construction software. It's going to merge with asset management software. And so we've got to work together. That's why if you're just doing things with prop tech to do the same old stuff more efficiently, I really believe you're on the wrong road, because that's not the way things are headed. So we're investing. We're now operating several hospitals with their software systems, and a couple of commercial clients. We're working post-construction with them on their operations. And I'll just mention, although it's a little off topic, I was calling yesterday saying, when are those goddamn robots coming for our new manufacturing facility? And they're late, but they'll be there soon. Anyway, the world is changing quickly, and Ellis-Don, who will be a software company, or we won't.
So So interesting. You can't have a GTA real estate conversation without addressing housing. So single family home prices are continuing to rise. Demand for smaller condos favored by investors pre-COVID due to their affordability appears to be declining as some renters flee the city, while others who can afford it seek more square footage for working from home. Are you adapting your investment strategy to meet this shift, or are you taking a wait and see approach? And can you also speak to how to attract people back into the city before and after the vaccine will become more widely available? And if we can have Renee and then Ray and then Ali.
So our company is fortunate in that we are already active in both the high-rise and low-rise markets. So it's not that we've had to pivot necessarily one way or another. And we're very opportunistic. It's easy for us to respond to quickly to demand, and we will do that enthusiastically. I think one of the things I wanted to comment on is a lot of people have been commenting on the fact that many people are making locational shifts now. They are choosing to exit downtowns and go and live in the suburbs. And I think we have to think about that in the context of your initial comment about affordability. I think those who are being able to make those decisions right now are people who are either already on the verge of doing that prior to COVID and who are in a position to be able to do so because they can afford to make that decision. I think increased demand for low density housing going forward or in response to this pandemic is going to be combined with the issue that we've already had of constraints on supply and on land for low-rise housing, and that's going to continue to exacerbate the affordability issue. So I think that is one of the factors that will continue to mean that we will have demand in downtown areas. And when you think about people who are attracted to the idea of the 15-minute city, downtowns and city centers will continue to be attractive for them for that purpose. So I don't know that we're necessarily going to have to do a lot of proactive work in order to try to keep people in cities. I think there are different demographics that will be attracted to cities and those who will make other decisions. And I think the ones making those other decisions were kind of already people whose lifestyles and position of being able to make affordability choices put them in the position where they were able to do that. Regarding the question of how things might change post-vaccine, I think housing choices are long-term decisions. So anyone who's making a decision to change where they live now is doing so not necessarily, I mean, a few people might have done it just so they immediately have a different or better place to work remotely, but I think most of them are doing so with a consideration of the permanency or the long-term nature of that decision. And I think, so anyone who's making that decision, I don't think it's necessarily in response to the fact that there's no vaccine now. I think what they're thinking about is the acknowledgement of what I said in the beginning, that this is not going to be our first pandemic or our only pandemic, or the only type of shock that forces us to work remotely or suddenly pivot and do things differently. I think they're doing it with consideration of how they will have choices available to them in the event of future types of shocks. And so I don't know that a vaccine is necessarily going to be the thing that makes people change their mind about these types of decisions.
Ray?
With all those comments that Renee just made, the challenge we're dealing with the rental market downtown is that it's been adversely impacted with well, it's a natural impact based on demographic shifting, and as people families grow, that they're looking for more space and to the suburbs. But in the short term, we've been hit with the immigration, we've been hit with business travel, and that's sort of impacted the Airbnb market. That some of those units have now switched from short term to long term rentals. So that's also caused an increase, and also the universities that the lack of foreign students and sort of education online. So that's sort of creating an inflated look at the downtown market from a rental standpoint. So the challenge we've had with this pandemic is that we skipped the cycle. We skipped the spring housing market, And there was a lot of pent-up demand, and we saw that in the summer months with the frenzy of activity and and prices. And going back to the immigration, when people immigrate to any city, they're looking to get themselves established, and they want to rent for 2 or 3 years before they can before they actually buy. So we're seeing that component impact the downtown. But with Renee's comments that this, especially with millennials, that they were sort of priced out in the last 5 years just because of the rapid increase in rental rates and scarcity of supply. And I think with the rental rates dropping by anywhere from 10 to 20%, that will cause an opportunity for them to get back in and look at those type of amenities and be able to live in an urban environment. So I think that some of the things that we're seeing with what's happening with the downtown now is short term, and I don't think it's going to turn totally back to normal, but I think it's going to improve as the vaccine comes in and as people feel a little bit safer going back into the workplace and public transportation.
Thank you, Ali.
Yeah, I think Renee and Ray covered it really well. You know, I think maybe I'll just touch on, you know, the adoption of investment strategy, because I think we're in Toronto, you know, we're still having net positive immigration flows in. And when I kind of compare that to kind of the major urban centers in the US, so you think about something like a New York, San Francisco, what you're actually seeing is you've been seeing net migration out of those cities for the last while, and people are moving to kind of Sunbelt. And so I think when we look at our residential strategy, particularly in the US, we are much more focused out of kind of the core traditional urban locations and into what would have been considered some of the secondary. And that's really because we're following the migration trends. And so, you know, if you're graduating from university, you know, people are saying, I want to move to Dallas, not necessarily New York. And, you know, look at 10 years ago, like everyone wanted to work in New York and New London. So I think and that's been a shift that's been happening, but I think circumstances like this can really, once again, you know, talk about accelerating of trends. So that is where our kind of a big focus of our growth is really expanding, particularly on our residential strategy, into markets that would have previously been considered kind of second and third tier markets are now kind of at the top of our list to kind of build out that portfolio.
Thanks, Ali. We have one final topic, last couple of minutes, and that's around ESG. Another aspect of changing expectations in Canada's real estate market is the growing focus on environmental, social, and governance factors. How are you adapting your business to incorporate ESG? And we'll start with Renee and then go to Ali and Jeff.
Sure. I know we're running tight for time, so I'll try to keep this short. One thing that I will say, I think on the issue of advancements in the area of in the environment, I think our industry is doing very well and will continue to do so. On the social and governance side of things, particularly if you frame that with respect to the issues of equity, diversity, and inclusion, I sort of feel like our industry as a whole is where we were on the topic of sustainability maybe 15 years ago, which is to say that people know that we need change and they want to do the right thing, but the path forward is not entirely clear. And I think these issues are so nuanced and complex. That means that real progress in this area is going to take a range of actions, and it's not ultimately that somebody is going to be able to issue a roadmap for us through, you know, a checklist or a formulaic approach. I think it's going to take a lot of education, a lot of introspection, and people willing to have difficult conversations, which means that efforts have to happen at both the individual and corporate levels. I don't think that is specific to our industry. I think it's happening everywhere. And I feel hopeful that growing awareness in this area is a positive sign.
Maybe we'll wrap up with Ali's comment.
Certainly. So I think this is really important, and I'm personally really pleased to see the increased focus in this area. And I think, you know, at Oxford, we feel that if we don't, you know, do our part to help address climate change, we're actually failing the communities that we're helping to build. So we're really focused in 3 areas. One, developing groundbreaking new buildings to push sustainability. So we're building an office tower in Vancouver called the Stack, and that's going to be the first zero carbon skyscraper in the world. So really excited about that, and working with partners such as Elliston in the construction industry to really continue to advance that. The second is really using data analytics on our portfolio. So I touched on carbon monitoring. How can we actually use the power of data and analytics to reduce carbon usage, reduce garbage, increase recycling, all those areas. And so that's really been an advancement in that technology, is allowing us to make some real gains there. And then finally, it's on a human solutions that promote change in our employees, our customers, and our suppliers' behavior. So it's a combination of all three things. It's not just one that's going to solve this, but those are really our focus areas to try to continue to advance this for the industry.
Thanks. Thanks, Allie. Some of the key messages we've heard truly reflect ETRE 2021, such as divergent views and uncertainty, acceleration of already existing trends, reimagining portfolios, a refocus of technology and leveraging data analytics, and the ever-increasing focus on cybersecurity and ESG in the coming year. Thank you to all of the panelists for taking the time to join us today and for sharing your insights. Back to you, Richard.
Well, thank you, Miriam. Boy, that hour evaporated. That was a fascinating panel. So thank you very much to Allison, Ray, Renee, and Jeff, and to you, Miriam, for a really great session. We're now breaking for 15 minutes for people to reconvene, have a little break, and reconvene under the concurrent sessions that everybody is pre-selected during registration. They are commercial, industrial, residential, and retail. It's important that you go to this session that you registered for, as they are pretty much sold out and full. And if people switch, we could have some problems. If you, for some reason, do not know how to get to your next session, or you don't know which one you are going to, hang on while everybody drops off, and we'll take care of you on this exact Zoom session that we're on right now. Otherwise, we'll see you all at 10:15 prompt. And make sure after that, just hang on after a quick break at 11 o'clock. At 11:15, we've got John Love teed up for a fascinating wrap-up fireside chat. So if you have, looking forward to seeing you there. If again, if any issues, hang out here and we'll get you all sorted. Otherwise, we'll see you back after the concurrent sessions. Thank you all.
Hello, everyone, and welcome back. My name is Andrew Garrett. I'm the Executive Director of IMCO and also ULI's Toronto Outreach Committee Co-Chair. And as steward of Ontario-owned commercial real estate, and we have $11 billion globally, it's my pleasure to introduce this session. We have strong leaders with our business partners, TD Bank and Kingside Capital, and it's my pleasure to introduce our moderator for the final program of the day, Aliyah Mohammed. Aliyah is Managing Director in TD Securities Real Estate Investment Banking Group, based in Toronto. Aliyah has 15 years of experience advising clients, most recently in the real estate sector on a wide variety of mergers and acquisitions. To date, she's advised in over $30 billion of mergers and acquisitions. She's also the recipient of the 2020 Women in Capital Markets Champion of Change Award, which recognizes excellence in leadership. Aliyah is also the 2018 recipient of Women in Capital Markets Rising Star Award. And really glad and lucky to have her today. So Aliyah, I'll pass it over to you to introduce our featured speaker for this session, who really needs no introduction. Over to you.
That's great. Thank you so much, Andrew. It was a very kind introduction. Very pleased to be here today with John Love for what should be a very insightful discussion on many topics. John, you're a very accomplished real estate leader, and if I did your bio justice, it could take the full 45 minutes that we have today. So I'm just going to touch on a few highlights for our audience. Ivy Business School, stockbroker, leasing to development to management at Oxford, ultimately the CEO, sold to Omers, founded Kingside in 2002, team of 120 people, multiple fund strategies, 12 billion of equity raised, and 15.4 billion of AUM later, here we are today. So I'd really like to make the most of the time that we have with you. So I'm going to jump right into it. COVID, US elections, Canadian political events, aging populace, increasing social unrest, concerns about inequality. I can't think of a time when we have been faced with more uncertainty than right now today. I'd like to talk about how you, as a business thought leader, navigate through a period like this. And let's start with leadership in a crisis. How do you describe what that looks like?
Well, thank you, and good morning to everyone. Well, leadership and uncertainty is certainly a different tool set, and I must say I have been through personally what I would consider to be more challenging times. The early '90s was breathtaking with fundamentally the destruction of our industry. The early '80s saw the really reset of Alberta, which was a really profound recession. So. I have been through some difficult times before. Now that said, I think leadership in a time of crisis is one of, you have to have, some vision, some optimism, and some perspective, for your team. We started off, I think the crisis started March 15th. And immediately after that, I found myself every day, I would send out a communication to all of our people before 7 a.m. talking about the events of the day, because every 24 hours seemed to be so dramatic. And giving people assurance that, KingSett had a strategy, business is going to survive. Let's put things in perspective. Here's what we need to do. As we've moved on over the last 5 months, 6 months, it's shifted to how do we play offense? How do we sort of look at what's happening and how do we move forward? Because in times of uncertainty, there's challenges, but there's also opportunities.
That's great, John. Let's dig in a little bit more. You touched on kind of areas of opportunities, and the offset to that is risk. How do you manage risk? Do you consider yourself a high risk or risk adverse person? And how does that play into your risk management and decision making in the context of the uncertainty we're facing today?
Well, for me, I wake up every morning afraid, and it gets worse as the day goes on. And it's because of that risk focus is why I'm here today. I would tell you that as I think about situations, I always go to the darkest corner of the room. What's the worst thing that could happen in this set of circumstances or this set of facts? And I find that if I get in the deepest, darkest part of the room and start to think through what would we do then it allows me to have a broader perspective of what are the more probable outcomes. And because I'm confident that even in what I could imagine as being the worst possible outcome, that we have a way to manage that in a way out of the room. And the other thing that's important in thinking about risk, particularly enterprise risk, is it's not a solo sport. It's fundamental to have a team with you, people around you, co-workers, whatever it is, that you can share your greatest fears, talk about risks and the opportunities. But as you focus on that risk metric, as you have a group that can talk and think about those risks, it really can enable some creative thinking, but also some assurance that you're kind of all in it together and you've got a plan.
It's great perspective, John, and inspiring as well. Thank you for that. Before we focus or narrow our focus to real estate, just to level set, broadly speaking, how long, leading sectors, et cetera, what does an economic recovery look like in your view?
Well, I think that the context we're operating under is coexisting with COVID. And because I think, this is going to go a little bit, longer than perhaps some people think. People that have not been through a crisis before, particularly younger people, are, particularly anxious, about the set of facts. So I think this will go longer. And I think that once we round the corner, I think it'll actually be a fairly sharp recovery. Once we either feel safe because there's a vaccine or therapeutics, or we feel safe because we've identified really who are the risk groups and the non-risk groups, whatever that outcome is, I think people will say, you know what, like, I want to go to a restaurant, I want to get on a plane, or I want to travel, or I want to do whatever. And I want to get back to the office, and I want to go to we'll want to be who we were, because at the end of the day, I think we're social animals. So I think that will happen relatively quickly, but whether that's in 3 months or 12 months, I don't know. We'll see.
It's a perfect segue actually into kind of the next question I wanted to talk to you about. You mentioned kind of return to some, behaviors that we used to have pre-COVID. In the media and the press, there's just a lot of content on the future of the big city. Are we starting, as PwC aptly phrased it in the report, a new chapter for urbanization? John, what's your take? Is the metropolis dead, or is it just hibernating or evolving?
Yeah. So I think, the power of the city started several thousand years ago, and I don't see COVID changing that narrative. I mean, the fact is that the growth and ideas and excitement and so on, is something that is a team sport and not ideally isolated. People that like the big city, that like a Toronto, I with my wife live in an apartment downtown, still get energy from that same set of facts. I don't think that's changing. But that the proposition that people will all move to Kappus Casing or Concord, wherever that is, I just don't think is going to happen. Now, will some people move? Of course they will. But people moved a year ago, 3 years ago, 5 years ago. But as we become safe again, like this city will continue, Toronto will, I think continue to be the vibrant hub that it's been. And I don't see anything changing that set of facts. Now, will there be some changes? Of course there'll be. And I think, office will, every asset class will evolve a little bit and transition a little bit. But the core premise, my core premise, is that we still get energy from each other. And being in a room with someone else, I'm in the same room with Aaliyah, so I can look at her and get some energy versus just looking at a screen, is something that we all thrive on. And the fact is, ideas are a team sport. Mentoring doesn't suit itself to scheduling. It's something that happens continually and is something that you get live. So building relationships, is not a 2D element. And, relationships are the currency of business. So, we will be back. It'll be different, but it was going to be different anyway. So it's always different. So I sort of think, we're on pause. We're all hiding, a little bit. We're not seeing our grandchildren or because they're going to school in their petri dishes to begin with. So we're all doing things that are different than what we did before, but that's not where we want to be once we're able.
Oh, that's great, John. You mentioned asset classes are all going to shift a bit. So why don't we touch on that? Can you give me one sentence here? And let's start with retail.
So I actually think retail could be the biggest surprise. And I say that because expectations are so apocalyptic. And, I've always found that when expectations are apocalyptic, they're exceeded. So I think retail could actually be a bit of a pleasant surprise. The fact is that there's going to be all sorts of changes and malls, et cetera, will have to adapt to presenting a different product than they have in the past. But actually, I think retail could do better than some people think.
Office?
So office my view is will be back. A lot of it will be in a hybrid model, but here are the factors that are going on. Three things. Number one, densification is dead. And so we're going to see, everybody take more space per either seat or per person, however you want to describe that. Secondly, is that we will see, growth from new tenants. We'll see, continue to see tech and so on can, absorb, more space. But thirdly, people say, remote work is work, and it does work as long as we're all remote. So as soon as some are remote and some are not, the people working from home will all have FOMO. And guess what? It won't be a fear. It will be the actual of missing out.
Industrial.
So industrial is interesting, because everybody talks about industrial as a homogeneous asset class, but of course, as we know, there's all sorts of different asset classes that compose industrial. So there's big box distribution centers, which is really a focus and hot today. There's small bay industrial, which has smaller businesses, and it is having some elements of challenges, and in between. But I think we're a big fan of industrial. At the moment, and I think that'll continue to do fine.
The residential market?
So multi-res, I think will continue to perform because people have to live somewhere. Now, of course, what we're seeing at the moment is, we're seeing that at the high end, it's struggling. And the high end is condos, but also, buildings like our 2 St. Thomas, which was achieving some of the highest rents in the city. And, it's facing some challenges it hasn't faced before. But if you're looking at sort of regular garden variety, multi-res, it's doing pretty well. I mean, the secret for multi-res is we've got to restart immigration. We've got to get students back. And the fact is we're in a recession, but the recession will end. And when the recession ends, immigration starts again, and students are back, demand will pick up and on we go.
There's a great chart in the PwC report that ranked the real estate subsectors according to their prospects for 2021. John, how do you read that chart and translate it into areas of opportunity for the future?
So I always do the same thing with that chart because I think it's very interesting. It's a survey of everybody's interest. You sort of rip it out. You circle the things that everybody's most interested in, and you say, is there anything that we have here that we should sell? And you look at all the areas that nobody's interested in and say, is there anything here that we think we should buy? Because it turns out that what's least in favor can often present the most interesting opportunities, and what's most in favor can sometimes be overpriced. It doesn't necessarily mean you sell those assets, but it does mean there's a liquidity window if you have any of those kinds of assets that you don't love.
That makes a lot of sense. Let's switch gears here for a moment. ESG, sustainable impact investing, these are getting more and more attention in both the private and public capital markets. You recently launched an affordable housing fund. Talk to us about the power of real estate development in creating positive outcomes for our society, and if it's possible to do so in a financially profitable manner.
I think ESG is hugely important because I think that the reality that we have to go through is that in the fullness of time, we will find that that any consumer, whether it's an employee or a tenant or an investor, any counterparty, when given a choice, will elect to go with a provider that whose ESG strategy best aligns with what they're doing. So, on the energy side, many of you might know we've got Scotia Plaza has now been certified as zero carbon. It's actually a big accomplishment. Zero carbon, largest building in Canada to be that. We're working on the same kind of energy initiatives throughout the portfolio and making some great strides. We're looking at waste diversion, water diversion, or water using less water, doing a whole variety of things. We're on the S side. We're looking at our employment practices and other things in our business, but also in our system where we can be more effective. And then on governance, we're also looking at different elements there and trying to benchmark us to best in class. The initiative in affordable housing is again targeted to try and make a difference, and the stakeholders in that fund are people that are interested in just that.
That's very encouraging to hear, and congratulations on the accomplishments for Scotia Plaza. The capital markets, John, it seems like there's a growing disparity between where private market assets are transacting and where the public REITs are trading. Which is leading which here? Do you see upward pressure on cap rates as private market deal flow picks up, or are discount to NAVs going to tighten up for the REITs?
Well, I'd start with saying I think that it's very difficult for external analysts to properly understand what the net asset value of a REIT is. I think as we go forward, best of class assets and more commodity assets are going to separate from value even more than they have in the past. And so if you look at a lot of the REITs, you'll find that while the better ones do have some best in class assets, they also have some others that are going to be increasingly difficult in the go forward market. I'm not of the view that any of the REITs are particularly undervalued.
It's an interesting perspective and a very fair comment as it relates to trying to value things from the outside looking in. I wonder if we kind of turn the corner a little bit here and touch on some politics. I've been waiting to ask this question, and I think I've been rushing to get here because it's a bit of a magic wand question, John. If you could push through any single impactful piece of policy today, what would it be?
Well, if I was running the world, which would be a horrible thing, but I would rally the country around Buy Canada. I would have the green energy corridor from the east to the west. We shouldn't be selling Quebec's electricity into the eastern US so that Alberta has to burn coal for electricity. We should be taking Quebec electricity to Alberta. We should be taking Alberta oil to Quebec to displace the oil that's buying from Venezuela and other places where we criticize them for their environmental and social behavior, but somehow we support their economies. But I'd also, as a Canadian, we should be buying our own wood. We should be buying our own manufactured goods. We should be rallying around onshoring, and onshoring not being North America, but onshoring being Canada. We should have, so I would focus on trade corridors and free trade in Canada. I mean, we have freer trade with the US than we do interprovincial, which is ridiculous. And so I would rally the country around, we should buy Canada, and I'd wrap the flag around that.
It's a great concept. Could we dig in a little bit? What can we do, or what should be done as it relates to immigration, which is so critical to real estate, not to mention the economy more broadly speaking?
Well, Canada's had a great immigration policy for some time. And the immigration policy is largely focused on the points system, which has meant that it favors skilled workers and so on and so forth. Then they put in a tech bypass where if you, for example, had were an immigrant but you had a job offer from Microsoft, you could get a visa and a work permit in 2 weeks. It's been a huge competitive advantage for us, and so that immigration policy has been good. Now, of course, because of all the travel restrictions and so on, largely immigration has been throttled over the last period of time. We need to start to restart that pipe because we need that skilled labor from around the world. We should be quite happy to accept the brightest and the best globally to help build Canadian businesses, and because that's where the growth in business and our economy and our tax revenues are that are required to support our system.
Yeah, and sticking on what can be done, let's move over to transit. There's some interesting context in the PwC report about transit-oriented communities popping up. What do you make of that, and what needs to happen from a political perspective to provide the infrastructure that's needed?
Well, I mean, if you have a dense city, you cannot rely on the car. I mean, because you can't build enough roads to move this many people around. If you think of Toronto, just as an example, over the last 30 years, we've tripled the population and actually reduced the amount of roads because of bike lanes and so on. So obviously that's a total mess. So we need more public transportation. But the secret to public transportation is not money. There's lots of money been promised. It's execution. It's actually getting it done. Do you ever wonder why it takes us 10 years to do the Eglinton Crosstown, where you can do the same project in 3 years in other parts of the world? Well, it's not because our contractors aren't any good. It's because the regulatory framework and the barriers to execution are so overwhelming that these projects just go on and on. I was encouraged to see the Premier's office, who we've lobbied on this issue, recently came out and said they are coming forward with some changes to infrastructure construction protocols, because we need way more public transit. And I think, and having the 15-minute city, having hubs where there's all the services you need to live around those transportation centers makes tons of sense. The reality is, the white collar workforce is going to stay concentrated in the center of a city because that's where all the transportation goes. That's where the ideas are. And while, people talk about, suburban settings and so on and so forth, if you're in most organizations, you would say, well, maybe that's for that person, not for me. I've got to be in head office, right? It's going to continue to be the magnet for the best and the brightest and the most significant jobs. So we do need to recognize the extreme role of transit, and we've got to get on with it. And that's not money; it's changing how we build.
There's been a lot in social media lately, just kind of calling on on different levels of government and asking for bold leadership as we kind of move through this pandemic period. What's your take on that? And do you think that's something that the governments can deliver to us? And what do they need to do so?
Well, let me see. Bold leadership from our politicians. Well, I think that's a high bar. Business leaders have to speak out. I mean, I posted on LinkedIn yesterday some work done by the Business Council, and it's a worthwhile reading on what the Business Council is advocating, which is, a combination of, we've got to be very aggressive in managing and curtailing COVID, no question about that. We also have to put COVID, this is me talking, not them, in a broader healthcare narrative. Because remember, while we are focused on COVID, we're also postponing all sorts of needed surgeries and other procedures that is causing great concern for many people that had something that needed to be done. And we've also got what is an untold at the moment healthcare, mental health crisis coming out of this COVID crisis, because all of the isolation and so on has created all sorts of other issues. So that's healthcare. But then the economy, we somehow have to get back. We can't continue to run $1 billion federal deficit a day. That's $1 billion a day. It's actually a little more than $1 billion a day in deficit. I mean, at some point, our creditors will tell us how to run our country. That's not the case for Americans, because the U.S. is such a big, it's got such a big presence in the world. It'll never be the case for them, but it will be for us. And this is similar to in 1992, when the head of the IMF said, just after they bailed out Mexico, that next up was Canada with the Canadian peso. And that galvanized the country around one issue, which was deficits. And I remember watching the 1993 leadership debates, and each of the NDP Conservatives and Liberals were focused only on their deficit strategy. They had different plans. NDP wanted to tax, Conservatives wanted to cut spending, and the Liberals wanted to do some of both. But that was the entire discussion. And coming out of that period, the winning Liberals, who did a good job, but they had two tailwinds. One was GST had just come in, and that gave them about $40 billion a year to deal with. Secondly, we just fully implemented the U.S. Free Trade Agreement, and the U.S. economy was on fire, buying everything Canadians could make. So with those two tailwinds, and a credit to the government at the time, they didn't squander that. They balanced the budget, built up reserves, brought our debt down, and so on. If we think of, in the GFC, the global financial crisis, 08-09, which was really a made-in-TV crisis for Canadians, because, few of us lost our jobs and even fewer lost their homes, unlike other places in the world. But that said, the stimulus at the time for the then Harper Conservatives was the stunning number at the time of a $50 billion deficit, but it was all in projects that had a beginning, middle, and end. And those projects basically built a building on every university campus across the country. And then they were over. And so we were back to balancing our budget. My concern is here, we've got this gargantuan deficit that somehow leaders have to get themselves out of. And by enshrining program spending, it's going to put a great burden on the economy. So we've got I'm not criticizing decisions people have made over the last 6 months, because God knows those are difficult times and difficult decisions to make. But as we go forward, we have to do so with a fiscal anchor. We've got to have an objective. We can't just continue to spend.
No, it's very well said, John. I think it's it's a big concern on everyone's mind, and finding that kind of balancing act is going to be critical as we move forward.
But to come back, I didn't answer your bold ideas question.
I was just going to go. Perfect.
My bold idea was, buy Canada.
Buy Canada.
Let's have the green corridor. Let's focus on selling east-west. Let's power the prairies in Ontario with Quebec Hydro, and let's fuel on Eastern Canada with Alberta petroleum products. And let's make sure that Canadians buy Canada first. Let's buy our manufactured products domestically. When Trump said we couldn't buy 3M's PPE, like that should be a 911 for us. We should be making our PPE here. Let's move on.
I think you're exactly right. Let's take that bold leadership theme down to real estate. What does leadership in the context of this market in real estate look like for you today?
Well, I think first of all, we have to be talking to all of our stakeholders and our constituents and reassure them of a number of things. First of all, that our buildings are safe, protected. We have programs, and all of the major landlords have been working together very constructively to come up with similar policies. I think we have to accommodate our commercial and retail tenants that are struggling the most. We've got to show, there is in the retail space some bullies, and we'll have to be tough with them. But for the others that have a legitimate plan and a go forward strategy, we should be, accommodating them and dealing with them. We've got to be dealing with our residential tenants and understanding that, at the moment there's been no stress, but if there is some stress, due to circumstances, we should, show some ability to repackage their deal or, whatever without a stress. So, but leadership is mostly talking to people and saying, let's play offense. We are talking here about what, where there's opportunities. We're closing the $5 billion Northview acquisition. I think the actual wires have gone and it closes on Sunday night or something like that. Anyway, we'll be proud owners. You'll see a press release before the market opens Monday. Hopefully that's not secret information. I don't think so. Anyway, we're going to take that portfolio and really do some interesting things with it, we hope. This is the time that leadership looks like, we have some challenges. Let's take them on. And there's some headwinds. Everything's a little more difficult than it was, right? That's okay. But let's deal with those challenges and let's look where the opportunities are. And I think for individuals, reach out to a team. Make sure you're talking to your coworkers. It's so difficult today, if you're not in the office, because normally if you're in the office, you can shoot the breeze, you have a coffee, you wander by, it's all that stuff. If you're allowed to do that, do more of it. If you're not allowed to do that, then try and simulate that on Zoom, because there's nothing worse than having people feel isolated, because that's when you feel fearful. We with social media and the 24-hour news cycle, that theories that are relatively radical get way more airtime than they deserve, and that can be unsettling for many. And the way to sort of package that and deal with it is reach out and touch someone.
That's really interesting. And just speaking of social media, you have a very active presence on LinkedIn, which is great. I learn a lot by clicking on the articles that you share and kind of reading your caption to them. But is there, can you take it up a notch and kind of share with us what your view is, what you're trying to kind of instill as a confidence in kind of our country and the opportunity? Is it just information, educate yourself? What's your intention there?
Well, I think sort of the source code is that, business leaders spend too much time talking to each other in a closet. So they share their ideas, they share their knowledge, they share all sorts of things with only each other. And whereas other aspects of our society, have a microphone and want a microphone. And I think if business is going to make its views known, it has to do just that. So what I'm trying to do is I think it's a responsibility for all business leaders, myself included, to highlight things that we think are relevant or comment on things that we think that are important. And I cover a wide range of things, some of which touch on real estate specifically, some which are more country central. But the country centric all affects real estate anyway. My total goal is, how do we make a stronger, more prosperous Canada? And that's not just one segment of the country. In the perfect world, every Canadian would have greater opportunity, and no Canadian would be marginalized. So how do we make that a better society? Because the extent that we can make it better for all, it's better for all of us. So I think it is important to speak out, but it's not just leaders. I think everybody needs to speak out. We all need to get into the conversation. In the perfect world, people would share with their families, neighbors, community, co-workers, whatever that is, ideas that might resonate or issues that might resonate, or at least it'd be nice if we were talking about these things because they're important to Canada and they're important to all of us.
That's very well said. Communication is so incredibly powerful. So it's a great thing that some of the social media platforms have brought us, but also need to be mindful of people using them for the wrong reasons. Along that theme, with all the headlines, and as certain headlines go viral and get more attention probably than they deserve, is there anything missing from those sound bites? Is there something that the leaders should be saying? Is there something that the real estate community should be advocating for? Is there anything missing?
I think I'd like to see more leaders talking about issues that are important to them. For sure, it doesn't matter that we all agree. In fact, A, we wouldn't agree, but B, it's an important narrative. And I think we've seen that in our society, certain things that were, whether it be politicians or the church or other leaders, religious leaders or political leaders or others, lose stature because of all sorts of reasons, which are, regrettable. And in fact, in surveys today, business leaders are amongst the most trusted, source for views and so on amongst the general public. So we need to speak out. And I don't think any topic is either on or off base, because it is now people that read what I say or hear what I think may say, well, I don't agree with that, which is totally fine. And for sure, not everybody will agree with what I think. But if people just think about the subject and think about what their view is, I think that's a worthwhile objective.
Shifting gears slightly, I believe there's a number of people in the audience that are perhaps at earlier stages of their career, and wanted to offer them a few moments to kind of get inside your head and kind of learn from some of your experiences and benefit from your wisdom. So, if you and I were in a private audience and I was kind of newer to the industry, earlier stage, what would you tell me to pay more attention to or be cognizant of as I'm embarking on kind of, building out that career in real estate?
So I'd offer two thoughts. One is values. We talk about that a lot here. I've talked about it, my whole career, because I would tell you that it's my view that a strong adherence to values is the most fundamental thing any successful business leader achieves. I mean, we all know people that, have achieved some apparent success that have weak values, but that's not a sustaining model. So the sustaining model is thinking about your values. And so I would reflect back to a young person, say, why don't you think about what your values are and stay true to that? Be authentic, be transparent, be open, be trusting, trust and be trusted. So just thinking about those values, I think, is number one. I'm actually going to do three now. Number two is work in the moment. I see many young people who, interested in career in real estate, whatever, they're always thinking 5 years out or 10 years out. I think the most important time to think about is 5 minutes out or 10 minutes out. What were you supposed to do today? And how can you do whatever that is just a little bit better? How can you exceed expectations every day? Because if you do that, somebody will tap your shoulder. Don't worry about it. I mean, I would tell you that I've always been able to walk. I mean, in Oxford, I would walk around and walk into an office, and you knew right away who were the players and who weren't. Because, the people that really were on their marks weren't asking for attention. But if you asked them a question, they always had the answer. And, those are the ones who you'd say, you know what, this one's worth investing in. Let's move them into another position or grow them or, whatever it would be. So number two would be really focusing on the here and now versus spending too much brain damage thinking about how do I become a vice president 5 years from now or whatever. The third thing, which is sort of is the currency of business, is building relationships. And, building relationships is everyone around you. And it is a combination of treating people with respect and giving people, understanding something you can do for them, thinking about the other person. Often kids coming out of business school, we told, well, you've got a network, so network. But they never say what that means. And
what does it mean?
you know, I learned at an early age that if I met someone and had something they didn't know or had an idea or something like that, people wanted to see me again. And so whenever I see someone, even today, I always try to think about what is something that might be helpful for them, a piece of information, a view, a new idea, whatever it would be, because you want to be relevant. And because networking is about relevance. And so, you know, I mean, in my world, and of course, I'm sort of frustrated because I got a bag over my head in the corner right with COVID. But, you know, in my world, normally there's 20 business days in a month. Turns out I have lunch every day. I have breakfast every day, but some of them with my wife. So I've got 20 opportunities for lunch and say another 10 for breakfast. That's 30 times I can see someone and ask them what they're thinking and offer an idea that I've got. Just think of the power of that. Now, being down for 6 months, I've lost 180 opportunities to see people. So I'm going a little squirrely, but it's happy to see you all here, I guess. But so networking, building relationships, and building relationships is really about being of value to someone else. Don't think of what it means for you. Think about the other person's issue that you can help them with.
Yeah, I think that's great advice. Fantastic advice, actually, John. One thing that I think is pretty powerful, as you spend more and more time in this industry, is you build on your experiences and you build judgment from what you've seen. If you actively analyze it and internalize what you've learned. Could you take us back to an example, whether it was at Oxford or earlier days at Kingset, where something that you worked on, a deal that happened or perhaps that didn't happen, that's given you some insight or some grounding as you kind of look forward through coming out of COVID?
So I've got an hour and a half of those stories, but I'll pick. Okay, so I started leasing space, and I was told that the rent we needed is 347 Bay, 1980. We needed $8.50 a foot, and I was supposed to ask $9. So I go see the first guy, and he says, "What's the rent?" I said $9. He says, "How about $8?" I said, "Split the difference, $8.50." He says, "Done." I see the second guy. I say $9. He says $7.50. Thinking on my feet, I say, "Well, split the difference, $8.50." And he said, "Well, that's not splitting the difference." I said, "Close enough." And so he said, "Fine." By now, I think I'm an expert. So I went to see the third tenant, biggest tenant in the building, 2,200 square feet, been with us 30 years. He asked me, he says, "What's the rent?" I said, $9. And he said, "Okay, well, now what do I do?" Because you can't screw the good guy. So then I'm with my little calculator trying to figure out 50 cents of improvements and so on and so forth. Avoid that bullet. So the fourth guy, I go see him. He says, "What's the rent?" I said, $8.50. He says, "How about $7.50? I said, "Let me tell you my story." And, I've told that story in deals 1,000 times since then, because the point is that we don't have to always assume we can sport grind somebody else. That if we have the respect and the transparency to say, "This is the rent I need, I'd like you to pay that rent." And if you'll say, "Well, surely you'll do something better," and say, "Well, let me tell you my story," that people will respect that. And it's part of building relationships is having a respect of other people and dealing with the integrity and transparency that everybody knows they're getting a fair deal.
It's a great story. We're starting to get to the end of our time, but before we let you go, I have a few one-word answer type of questions for you, if you're ready.
I'm ready. This isn't rehearsed.
Biden versus Trump.
Biden.
When is the next Canadian federal election?
February.
Most exciting niche asset class to emerge?
Niche. I don't like any niche asset class.
No?
No.
Fair.
I hate niches.
What's the habit you find most annoying in others?
Being late.
What's the trait you admire most?
And I'll tell you why being late. Being on time is 5 minutes early, and it's respect. But let me just tell you one other story while we're here. So, as a stockbroker, I would go see prospective customers, and I learned that if I showed up 5 minutes early, then when that customer came to see me, they'd always say, "Sorry to keep you waiting." What a great way to start a call. So, ever since, I've always been on time, and or I've always been early because people always think of you better. Sorry, I digress.
No, that's great. Subway or car?
Subway.
Favorite band?
Eagles.
Favorite Zoom meeting outfit?
A Zoom shirt, and we don't need to go into ref.
Mask or no mask?
Oh,
Let's see it.
mask.
That's amazing. Thank you so much, John. I wish we had another 45 minutes. I've got another 3 pages of questions that I would have loved to ask you. But thank you so much for your insight, your wisdom, and your perspective on a range of topics.
Happy to join everyone today. Have a great day. Great weekend.
Well, I want to thank you both. Richard Joy here again from Urban Land Institute, Toronto. That was amazing. Really great conversation. I love the rapid fire at the end there, Ali. That I really think that was a most revealing a conversation, and I think it was about 10 years ago that we had John on a fireside chat, and one of the things that people remembered about it was how forthcoming you were and how bang on your comments were then as they are today. So thank you, both of you, very, very much for a great way to cap off our program. And just the fact that people hung on tells you it was very, very interesting this far into the day, half a day. That's a lot of Zoom. So on behalf of the management committee of the Urban Land Institute, I'd like to thank everybody for spending your morning with us. Thank you again for PwC for your support of this program and for an incredible chapter in the annual report. And to our annual sponsors for your continued involvement and support. And to all of you, I wish you a very happy Friday and a great weekend. And we hope to see you very soon at a ULI program in the near future. All the best. Bye-bye.